Hello, my name is Kai, and I am a bit of a rambler. I like to travel, learn, and tell stories. Today I want to talk about something that has saved me tens of thousands of dollars since I started traveling. It's called the FEIE, the Foreign Earned Income Exclusion. It is part of the US tax code. It is legal, and it means you don't have to pay tax on your earned income up to a certain amount. Now, unfortunately for Americans, their tax laws are predicated on citizenship rather than residency or being in the country for the most part, or anything else. If you are a U.S. citizen, you will always file your taxes and almost always pay taxes on your earned income, regardless of whether or not you are using any of the services that the U.S. provides. So, why should you know about this? Because one of the very few situations in which you are not paying taxes is if you are traveling for an extended period. If you leave the U.S. for more than 330 days in 1 year, then you can apply and automatically receive the Foreign Earned Income Exclusion credit, which means that up to $125,000, I believe it's $126,500 this year, it's an adjusting number, but $125,000 roughly of your earned income from the tax year you are outside of the U.S. for 330 days or more are exempt from tax. Now, the first year, I think I did pay full taxes because I just didn't know about it, and nobody around me knew about it. Some of the teachers I knew in China were simply not paying taxes, which is illegal, and others had just never heard of this foreign earned income exclusion, so they just paid regular taxes to the U.S., even though they had not been in the country for 5 years or in some cases 15 years. I came across this tax code, and I was like, oh, wait, what? And it's called the physical presence test. If you're not in the U.S. for more than 330 days out of the year, you don't pay taxes on your first $125,000 of earned income, the income you get directly from your job, not dividends or royalties or stuff like that, which you would still pay tax on because that is unearned income, or self-employment. So any company you work for and you get paid from, that earned income is counted under this exclusion. But if you are self-employed, the self-employed income will not count under the FEIE, so you would still have to pay taxes on self-employed income. But if you're working for a school, English teaching school, or any other company while you're abroad, that's all excluded. But if you just have a job, like teaching English in a foreign country, for example, you can be in that foreign country for 11 months out of the year. So go to Japan, teach English for 11 months. You can take a month off each year, go back and visit your family in the U.S., and then when you pay taxes, you state it's one extra form called the FEIE, or Form 2555. So you fill out the 2555, which is a couple pages. You basically fill out the dates that you were not in the U.S., where you were, and then you claim the FEIE. That's basically it. If they audit you, which I've never had, hopefully not jinxing myself, you just have to show your passport or your plane tickets or whatever that shows you were actually out of the country. But being out of the country, that's the only hoop you have to jump through. There are two ways to apply and receive this tax credit, but the physical presence test is much easier. The first question I want to get out of the way is this tax evasion? Which, no. There is a form for it, the same forms you fill out for your 1099, W-2, whatever. This form is 2555, 2555, and it's just another form you fill out with your taxes. There's a difference between tax evasion and avoidance. Tax evasion is if you just don't pay your taxes, like the Other teachers I knew in China who were just like, well, I'm not in the country, so I don't have to pay any taxes. And that is not how U.S. taxes work. They have a draconian tax system, and you always file your taxes, even if, like me, you are not going to end up paying them because all of your income is excluded by Form 2555. So that would be evasion, you just not paying your taxes. Also, when like a shell company hides its money in a foreign country with very good privacy laws so that they don't have to report their income and get it taxed, that's tax evasion. That is an illegal method to not pay taxes or file taxes on income or wealth. Tax avoidance is a different thing. Tax avoidance is very simply explained by deductions. Using regular legal tax deductions is tax avoidance. You don't have to claim your children as dependents, and you don't have to claim medical costs as like giving you a credit on your taxes. But if you claim those, you are using the principle of tax avoidance. You're using a legal avenue provided by the IRS to pay less on your taxes. You're avoiding paying the maximum amount of taxes. So these teachers were evading, whereas someone who claims a hospital bill and gets a credit on their taxes is avoiding paying maximum taxes, because there's no legal way to just not pay or file your taxes in the US, but there is a legal way to claim an exorbitant hospital bill on your taxes so that you have a little breathing room on your taxes or you pay less taxes. So again, evasion is an illegal way to not pay taxes, and tax avoidance is using the tax legal code itself to avoid paying maximum or extra taxes. You want to pay the minimum taxes legally possible. Form 2555, if you are traveling, is crucial. And I didn't know a single person who used it. And I knew a fair amount. How many? I'll say at least a dozen just within my schools, Americans who I hired in our schools, and none of them had ever heard of the 2555. So I made that sure to be part of my welcoming spiel when they came into the school. Hey, guess what? If you're out of here for a whole year, you don't have to pay taxes. You just fill out this one form. And like I said, it's an extra 2 pages of work, mostly just filling out where you've been, what the dates are, and then clicking, yes, I am applying this physical presence test for the Foreign Earned Income Exclusion. Now, is it worth it? Yes, because it takes maybe 15 extra minutes to write down that you were not in the United States on your taxes. Probably faster if you've done it in the previous years. I have to fill out a lot of different, because I like traveling frequently, so I have to fill out like the 10 countries I visited that year. So it takes me, 20 minutes to write down my ticket dates and whatever. But really, less than half an hour, even if you visit a new country every month, and then you check a box that says physical presence test. As long as you're out for 330 days a year, you save all of your earned income taxes. So if you have a remote job and you made, let's say you made $35,000 as a teacher in Korea, if you were out for 11 months of that tax year, the $3,000 to $4,000 that you're paying on your income over the year, you save it. It stays in your bank. That is your money. You don't have to plan ahead for paying the taxes at the end of the year. You just have that money for yourself. And I've been doing that for 15 years. I don't know, a long time now. So yeah, do the math, but it definitely has saved me tens of thousands of dollars over the years for, I'm doing my taxes anyway. I have to fill out one extra 2-page form, and I save thousands of dollars every year. It's a no-brainer. Is it worth it? Is it worth the trouble? Is it worth the risk? There's no risk. This is a completely legal and normal IRS tax form. As long as you're outside of the country for 330 full days out of the year or more, you don't pay taxes on that first $125,000. It's that simple. Now, what's interesting to go through also are how the 12 months are defined. They do have to be a consecutive 12 months, but that doesn't necessarily mean it has to be January to January. If you pay your taxes in March, then it could be March to March, March 7th to March 7th, March 7th, 2018 to March 7th, 2019. It doesn't have to be within one calendar year. You are paying your taxes on the dates that give you the most exclusion. I will read out the points on the 12-month plan because I know that's counterintuitive, but these are the rules that the IRS provides with this income exclusion. So here are the 4 main points that the IRS lists to qualify for having this 12-month period, 330 days within a 12-month period. A 12-month period can begin with any day of the month. It ends the day before the same calendar day, 12 months later. January 7th, 2018 to January 6th, 2019. A 12-month period must be made up of consecutive months, so it has to be January to January or February to February. Any 12-month period can be used if the 330 days in a foreign country fall within that period. It does not say any 12-month period from January to January. Any 12-month period can be used if the 330 days in a foreign country fall within that period. You do not have to begin a 12-month period with your first full day in a foreign country or to end it with the day you leave. You can choose the 12-month period that gives you the greatest exclusion. And the 4th rule is, in determining whether the 12-month period falls within a longer stay in the foreign country, 12-month periods can overlap one another. I invite you to check it out yourself, but I have been following those rules for the past decade and a half, filing my taxes every year, applying my foreign earned income exclusion, and not paying any taxes that year. So I understand this is non-intuitive, and I didn't get it at first, but the IRS has a very clear example that it's not just 12 months within one calendar year. It is the 12 months that grant you the greatest exclusion. And they offer an example at the bottom of the page that illustrates this. So the official IRS example of a 12-month period includes you live, work, and have a tax home in New Zealand from January 1st, 2022 through August 31st, 2023. So if you go back in 2023 in August, 4 months you've spent in the US. So you would think, oh my gosh, that calendar year I can't use my foreign earned income exclusion. But no, the 2 example 12 months that the IRS provides in that exact situation is for 2022, you can claim January 1st to December 31st, 2022. But for 2023, since you returned to the US in August, you should choose September 1st, 2022 to August 31st, 2023. So as long as you have 12 consecutive months outside of the country, you can dip back into the former year or forward into the next year and use that 12-month consecutive period with which to apply the foreign earned income exclusion. At the risk of droning, which this is about taxes, so I get it. I'm going to give another example because I have done this before. For the first few years, I always tried to make sure it was within January to December, one calendar year. But then I finally read it more closely after the 3rd year or something. And it was good because that year, I didn't leave the US until March, I believe. And then I stayed in Japan the following year in March. And that was the year I really read through the foreign earned income exclusion. And I saw these rules and I was like, oh, well, it's been 12 consecutive months. Like, we can say it was 2018. I can't remember the exact year. But I thought, in this calendar year, I have been in the US for more than the 35 days allotted. But that's not the rule. The rule is that any 12 consecutive months, including that tax year, you can use as your foreign earned income exclusion presence test of 330 days out of the country. So from March 2018 until March 2019, I was in a foreign country for 330 days out of that 12-month period. And I filed my taxes, I filled out the form saying that, and I got my exclusion, and everything was normal, because those are the actual rules from the IRS. It's just, that's very good to know, because you don't have to worry like, oh no, I have to start traveling in January so I can claim this exclusion. No, you can claim it from July to July or September to August or whatever it is. It just has to be a consecutive 12-month period, and you have to have been outside of the U.S. for 330 days of that 12-month period. I hope that's clear enough. If it's not, write to me, I'll explain it again. I've explained it 50 times to people in real life, and I don't mind explaining to people because it's such a powerful tool with which to save money that nobody tells you about. So a few of the very common questions I get, I might have mentioned before, but how much time does it take? It takes 15 minutes to fill out, 10 if you only live in one country outside the whole year. Can you do it yourself? Yes, I have done my own taxes my whole life. If you don't want to do your taxes yourself, just make sure to include the 2555 with whoever you have file your taxes. Who can use this income exclusion? Anyone who stays out of the U.S. for 330 days in a 12-month period. How often can you use the FEIE? Every single year. What are the limits of the FEIE? So every year, the amount of earned income that you can exclude from paying taxes on is adjusted by the IRS, and it basically goes up a couple thousand every year. So, this year it's $126,500, I believe, if I remember. But it's about that, and it'll probably be like $128,000 next year or something like that. Is there a minimum amount of income that I need in order to use the FEIE and exclude that income? Nope. So if you make $15,000 a year, you can exclude that $15,000. If you make $125,000, you can exclude $125,000. If you make $250,000, you can still exclude $125,000, and you'll only pay taxes on the following $125,000, the other half of your income. You always get to exclude the maximum amount in the 12-month period that you choose that guarantees you the largest exclusion. Okay, so what's the catch? There is no catch. U.S. tax code is ridiculous. Many other countries, if you're not in the country, then you just write the number of days you weren't in the country. You don't pay taxes like that. Things are just more bureaucratic in the States, and the tax laws are crazier. So they don't figure out your taxes for you, even though they know them most of the time. You have to do all the work yourself in the U.S. So in this situation, if you are a traveler, an American traveler, this is the one thing you should definitely know. Because if you save $3,000 a year, that's easily half a year of expenses covered. If you're a traveler, or if you're, living it up, that's 3 months partying every day at $1,000 a month. That's just free money. There's no reason to pay the taxes. You legally do not have to if you're outside of the U.S. for 330 days out of a 12-month period of your choosing. So there's no catch. It's just a legal tax procedure that tax-paying Americans can take advantage of. Okay, you know what? Another question I always get is, does it count for foreign jobs only, or if I have a job from America, and I just happen to be abroad all year, does it still count? Yes. It doesn't matter what job you have. What matters is how many days you're outside of the U.S. I know I keep saying that, but it's important to make that very clear. If you have a completely foreign job, let's say you move to India and teach English like the whole time on site, it's a foreign company, all of that stuff, it doesn't matter. You make that money. When you pay taxes in the U.S., you fill out the 2555 and your income is excluded. In the same way, if you have a fully remote job as a design engineer for a corporation in the US, but they are fine with you working remotely, even though that's a US corporation and your job is fully American, if you are not in the US for more than 330 days out of a 12-month period, then you qualify for the FEIE and you don't pay taxes on $125,000 of your earned income. The qualification is your physical presence, not what job you have, not what country you go to, none of that. It's simply outside of the US, more than 330 days in a 12-month period of your choosing that provides you with the greatest income exclusion. It's great. Isn't that great? I was blown away when I found out about this because US tax laws are just awful and so unnecessarily onerous. So I was very happy to find out about this, and I've used it every year since. I think you should too. This also, importantly, doesn't mean you can't add on other deductions. If you make over $120,000, whatever, and you still have some income you can pay tax on, you can still take other deductions, office deductions, home office deductions, rent, hospital bills. You can still take all of those deductions as well. This is just another deduction you take, basically. It's just the biggest deduction, and it rocks, and all you have to do is travel to the country of your dreams and live there for most of a year. If there's anything I'm missing or anything that you're curious about or want some clarification on, please send me an email at bitofarambler@gmail.com, and I will get back to you. Because, I mentioned the rules earlier. They're simple, but they're sort of non-intuitive, and it just seems too good to be true, really. That's what the holdup seems to be for a lot of people that ask me questions about this. They just can't believe that all they have to do is not live in the country and then they can stop paying taxes. It's one of the only situations in which you cannot pay tax on your earned income in the US. Much better tax laws than every other country. But yeah, if you have any questions or clarifications, tax lawyers, get at me. Definitely, hit me up, write me up. And do your taxes while abroad, because chances are there is a free service. I haven't paid for federal taxes. I don't think I've ever paid for federal taxes. There's a free service willing to e-file for you, and the consequences of trying to dodge taxes is not worth the couple hours or days you're trying to save. Or if you're having someone else do it for you, it's not worth saving the $100 or whatever. U.S. tax laws they come with heavy penalties, and you'll be under scrutiny for the rest of your life, basically, if you try to evade the taxes, if you try not to pay the taxes you legally owe. So instead, I avoid taxes by traveling to countries I want to see and visit, and then legally following IRS procedure, claiming my income exclusion, and partying in Japan for the cherry blossoms, and then Guatemala for the volcanoes, and Portugal for the white cliffs and crashing waves. And by traveling, I don't pay taxes. It's such a good deal. So, get out there. Enjoy yourself. Write to me if you feel like it. Claim your foreign earned income exclusion. Enjoy yourself.